So the intelligent investor, so here is a comprehensive summary, about the intelligent investor, okay, by Benjamin Graham. Okay, so if I'm start from the introduction, that Benjamin Graham's, okay, the intelligent investor is widely regarded, as one of the greatest book ever written on investigating, okay, originally published in 1949, okay, its principles have stood, the test of time and continue to influence investors, okay, including Warren Buffett, who credit Graham, as his mentor, okay, Unlike that focus on speculation and market timing, the intelligent investor, emphasizes here, the intelligent investor emphasizes, very investing, a disciplined risk average strategy based on, to analyze rational decision making and patient, right? Graham's key messages, and what is the message of Benjamin Graham's, right, is that investigating should not be an emotional, game of chasing market trends or quick profits. Instead, it should be systematic process of identifying, undervalued stocks and holding them for long-term wealth creation. His principles focus on protecting investors, from costly, mistakes while maximizing returns over time, right? Okay, this summary breaks down, the core lesson from the intelligent investor, including, essential concepts such as value investing and risk management, market psychology and portfolio strategy, right? So here's the point one here, the difference between, investing and speculation here. Firstly, one of the most fundamental ideas Graham, stresses, is the distinction between investigating and speculation, right? Okay, investigating involves analyzing a company's financial health here, purchasing stocks at a reasonable prices, I mean to say, and holding them for long-term growth. It focuses on the, intrinsic value of a, business rather than short terms of market fluctuations, right? Speculation here, speculation on the other hand is akin of, gambling. It involves buying stocks based on high rumors and market trends without proper research. Speculation hopes to make quick profits, but often ends up losing money due to market volatility. Okay, Graham warns that many individuals in the stock market thinks they are investigating when they are actually speculating. He advises that an intelligent investor must develop discipline and patience to avoid falling into the trap of speculation, right? We have the concept to second point. The concept of Mr. Market, understanding market behavior. What is the behavior of the market? One of the most famous metaphors, is the intelligent investor here. The intelligent investor here, is Graham's portrayal of the stock market as Mr. Market. Imagine you are a business. Imagine, you own a business with a partner named Mr. Market. Every day he offers to buy and sell his share, of the business at different prices. Something, he is extremely optimistic and offers a high price, that we call the bull market. Okay, over times here he is overly, pessimist and offers a low price, right? That we call the bear market. Okay, and an intelligent investor does not allow Mr. Market's emotions to dictate investment, decisions here. Instead, he only buys when prices are low, stocks are undervalued, okay, and sell when prices are too high, stocks are totally overvalued, right? When it's going down, when it's going low, stocks are totally undervalued. When the sale is going up, that stock totally going overvalued, right? So that's the difference between this. Okay, the key here takeaway is patience and rationality. Okay, investigators here should avoid reacting emotionally to market movement and still instead take advantage of them, right? So here the third point is the principle of margin of safety, minimizing investment risk here. One of the cornerstones of Graham's philosophy is the margin of safety principle. A margin of safety means buying price significantly below their intrinsic value. This acts as a cushion against potential market downturns or misjudgment here in valuation. For example, in a stock fear, value is estimated to like $100 per share. Okay, and investor should aim to buy it at $70 or low, right? This way, even if the market declines, the risk of losing money is minimized, right? So here Graham's compared Graham compares this principle, to engineering. Okay, budgets are built to handle weights and much heavier than their expected load to ensure safety. Similarly, investors should buy with enough margin to protect against uncertainties, right? Okay, a large margin of safety protects investors from errors in judgment, economic downturns and unpredictable events, making it one of the most effective risk management tools, right? Here the fourth point is defensive versus enterprising investors. Okay, choosing the right approach here. Graham here classifies investors into two categories. A, the defensive passive investor. The defensive investor prioritizes safety and consistency over high returns. They prefer low risk investment, such as index funds, blue chip stocks and bonds, rather than actively trading stocks. This type of investor should diversify that their portfolio and avoid frequent trading to minimize losses, right? Okay, a simple strategy for defensive investors in investing in a balanced mix of stocks and bonds while holding them for long term. Okay, so here B point is the enterprising, that we call the active investor, right? The enterprising here investor is willing to put in the time and effort to analyze stocks and identify undervalued companies, okay, which is going low, right? Okay, this type of investor seeks high returns by researching financial statements, industry trends and market conditions, right? Enterprising here investors may also look for special situations such as mergers here, acquisition and distressed companies with strong potential. However, Benjamin Graham here wants that this approach requires here dedication, discipline and strong knowledge for financial analysis, right? The choice between being a defensive or enterprising investor depends on one's risk tolerance, time commitment and level of finance knowledge. And the point 5 is the role of diversification in reducing risk, right? The diversification of reducing risk. Graham strongly emphasizes the importance of diversification of protecting volatility. Okay, investing in a wide range of assets, stock, bonds and industries reduces the risk of major finance loss, right? If one company or industry suffers a downturn, other investments in the portfolio can help offset the loss, right? However, Graham warns against over diversification. Investing in too many stocks can dilute potential gains and make portfolio management difficult, right? A well diversified portfolio balance risk and returns, ensuring that investors have to not rely too heavy on a single stock or sector. Here the point 6 is the importance of dividends in long-term investing here. Benjamin Graham's favors stocks that pay regular dividends over speculation growth stocks. Companies that consistently pay dividends tend to be more financially stable and more profitable in long term run, right? In long run here, dividend payments provide income stream and can act as a cushion during market downturns. Okay, investors should seek companies with a history of growing dividends rather than those that reinvest all the profits into expansion, right? Dividend here, paying stock help investors build wealth gradually, consistently, making them as essential part of the balanced portfolio. Long term here, the 7th point here, the long term thinking, avoiding here, emotional investigating. Avoiding emotional investing. One of the most critical aspects here of the intelligent investor is controlling emotions and thinking long term. Many investors fall into fear and greed cycles, right? The buy when prices are high out of the excitement, and sell when prices drop out of the panic. The intelligent investor remains rational and stick to their strategy regardless of market fluctuation, right? Graham advises investors to view stocks as part ownership in a business rather than lottery tickets. This mindset helps in making better decisions. Okay, the market here will always experience high and low, but those who stay patient and invest systematically will reap rewards over time. So the conclusion of the story is or the book is the timeless wisdom of the intelligent investor. The intelligent investor remains one of the most valuable investment books ever written, because it teaches principles withstand the test of time, right? It discourages speculation and promotes the value of investing as the key to long-term wealth. Right, the principle of Mr. Market Margin of safety, diversification, and emotional discipline help investors navigate market fluctuation wisely. Whether one chooses to the defensive investor, that we call the passive approach, right, or an enterprising investor here active approach, success comes from discipline, patience, and rational decision making. So by following Graham's principle, the Benjamin Graham's principle, investors can avoid costly mistakes, protect their wealth and achieve financial independence in the long run. So this is the summary of what we call Think and Grow Rich by Benjamin. By Benjamin Graham. So yeah.